So now we have the impact and innovation panel. This one's different. I'm really excited about it. We have our moderator is Stephanie Rupp. She is the CEO of Tonic, and she is here to drive this panel.
Hello and welcome to the Impact and Innovation panel. So we have a very exciting group of panelists today, both from the nonprofit and for-profit sector. So I'm just going to jump ahead and introduce them to you all. The first is Premal Shah, whom I've known for a long time, so I'm just going to start with you. For each of these presenters, I'll just give you a little bit more color. Premal basically is a reminder of how I can stand corrected. At the very beginning of Kiva, I was one of the staunch Kiva skeptics. And I thought, how is this going to work? Zero interest loan, people are just not going to lend. And just look at how far they've come today with over 1.2 million borrowers. I also wanted to introduce you to Chris Walcott, who is the CEO of Semble, which is a for-profit that lends to nonprofits, and he'll tell you more about this soon. The touch point here, the color here, is that his company is within the Tonic network of investees, and so hopefully we'll get funded by some of our investors. The other, this time for-profit that is being presented today here is PAVE. So we have the pleasure of having Oren Bass, who is not a Yankee, but a Brit, who is the CEO and founder of PAVE, who is a former Goldman banker, etc., but is also trained as a boxer, but unfortunately was never able to fight anyone, so I hope he's kept the fight in him. And then finally, last but certainly not least, is Dave Gerard, who's the CEO and founder of Upstart. Dave has incredible background, having built Google's 1 billion plus cloud apps business worldwide. He was a former SVP at Virage and a Apple product manager earlier in his career. He's all about innovation and impact, even impact defined slightly differently. When he was young, he flooded his neighbor's house, attempting to build a hockey rink in his backyard. So some other more color on our panelists today. So today we're just going to talk about, my background's in social impact, looking for the double bottom line always. So the innovation and the kind of paradigm shift, that's what Tonic, my company, is all about. So today I'm going to try to tease out this double bottom line again, so regarding the businesses that are presented here, but also the impact they have in our sector. So first, my question to the panelists is going to be, well, describe quickly your business. I want people to understand what the innovation is here and what problem you're looking to solve and how. So we're just going to start with brief intros on the actual products that are offered here on these platforms. Oren, do you want to start?
Sure. Hi there. Thanks for having me. So PAVE is an affinity-based funding platform where individuals can actually receive funding from other people interested in seeing them succeed in exchange for sharing a future percentage of their income. So unlike traditional loans or other types of credit, the payments that people make on PAVE are actually tied to their earnings, so they're always affordable. And I guess what we're seeing is investors are actually investing for that double bottom line, for the ability to make a financial return, but also feel that they're doing good and actually impacting someone's future career.
Thank you. Chris?
Sure. Semble, as a platform, we've actually been working with the nonprofit community. And the reality is that nonprofits for decades have had needs of credits. And there's already a built-in community of people that are passionate, support those organizations. And what our platform does is when they have need of credit, instead of going traditional routes, providing a way for that community predefined, already existing, a way to provide a lower cost source of financing. And we truly believe it's one of the purest forms of socially conscious investing, because what it does is it frees up dollars that every single dollar that's freed up goes towards mission and helping that organization better serve the community.
Hi, everyone. My name is Premal. I help lead Kiva. Kiva operates 2 ventures now, 2 websites. We're a nonprofit based here in San Francisco. The first one is kiva.org. And the problem statement there is that all around the planet, there's a number of social innovators on the front line, like, for example, Mohammed Yunus and what he started with the Grameen Bank in Bangladesh, that are undercapitalized, and if they actually had access to more patient capital, they would be able to reach more people, like rural subsistence farmers in Kenya, with valuable inputs that would allow them to earn more income, the people that they work with. And so Kiva.org is a resource engine for institutions, typically NGOs, but also some social enterprises that work with very poor people around the planet, where you in $25 increments can lend through these institutions to help advance their work. More recently, we launched a new website called Kiva Zip about 3 years ago, and it asked the question, in the day of M-Pesa, which now is actively used in Kenya for mobile payments, 3/4 of the adult population uses it, and nearly 20% of the GDP is being transacted through this mobile payment system. And PayPal here domestically, I used to work at PayPal for 6 years. Could we actually go beyond working through an intermediary organization and go direct to these small businesses? And so Kiva Zip is a new website that attempts to do that.
Thank you.
Hi, I'm Dave Gerard. I'm CEO of Upstart. Upstart is, in essence, a lending platform for millennials. And the company was founded on a pretty simple observation, and that is that people in their 20s typically are not served particularly well by financial institutions, and particularly in the realm of credit, because they are sort of, in a blanket sense, considered risky borrowers. And that's because consumer underwriting, particularly in the US, has been pretty consistent for 40 or 50 years, looking at the TransUnion report, the FICO score, which tends to put all sort of inexperienced, thin file borrowers into the same risky category. So our innovation really is to look at data outside these reports that tend to be predictive of employability and creditworthiness and earning potential. And that is really the education data related to what they studied, where they went to school, how they performed academically. So we launched just a week and a half ago a simple 3-year fixed rate product that is in many ways similar to Lending Club and Prosper, but in other ways very different. Most fundamentally, it uses a different style of underwriting to focus on underserved, what we think of thin file borrowers that, at this old time, are very high quality borrowers. And secondly, we've actually, under the covers, combined something that is both a consumer loan and an education loan at the same time. So the borrower doesn't necessarily have to see all the differences, but they can use the money to pay back a credit card if they want to do that. They could use the money to take a coding boot camp course, which is very popular on Upstart, if they wanted to do that. They could use it to refinance a student loan. And in that sense, we've created a very, very simple, useful product that's very broadly available.
Thank you. And so what fascinates me in all of your platforms is not just the disruption to the system and who you're serving, who otherwise could not be served, but it's also the how, and especially around credit scoring. So I was wondering if, and we have a very diverse set here of approaches to doing so. I was wondering if we could just go again through the panel and just describe how you quantify risk and how you score this risk, and what is unique, what is the innovation in your risk scoring? Go ahead. Thank you.
Well, I get for the investing in an individual's future earnings, obviously has a credit element to it. So we do apply traditional and historic kind of credit underwriting formulation methodologies to what we're doing. But for us, it's actually an investment in a person's future. So we're looking at modeling out the potential earning of all these individuals. And so what we spent the last kind of year and a half doing is looking at all different data points out there, and we have thousands, if not millions, of data points to better predict what any individual in any different field is actually going to earn. And obviously we're not going to get it right in any individual case, but when investing in a group of individuals, it tends to get pretty accurate. So I guess our unique approach would be, instead of looking at something, I guess historically, what someone's ability to pay has been, we're looking at future earning potential and looking at this more from an investment perspective versus kind of a credit risk perspective.
Thank you, Chris. And just for the audience to understand, Chris's model stands out quite a bit because here you have P2P platforms, but this is a P2 community platform. Please, Chris, sorry, I just wanted to...
Sure, and I was going to mention that. Obviously, for us, it's the end borrower is not on the retail side, but actually a commercial borrower, and they have a track record. They have a history. Typically, with every one of our loans, we're aggregating past financial data. A lot of the loans, and the majority of the loans that we actually structure, they're larger in size, typically secured by actual physical real estate. So there's a lot of different components that differentiate this from kind of unsecured consumer credit, but we're always, and part of it is the source of funds for every one of our loan is the community that already exists that serves and believes in that nonprofit. And so there's that qualitative level of underwriting where they already know the organization, they believe in what the organization does. Obviously, we want them to be fully informed before they make an investment, but these are the people that in many ways create the creditworthiness for the organization to begin with. It's their financial support that even justifies a bank being involved in the first place. So when we walk into any one of the loans that we do, we are sitting down with the organization, structuring the opportunity, and the realization is not only is the borrower, the borrower is assessing it because this is their community they're reaching to, but the investors are well informed of who they're lending to.
With Kiva, on the kiva.org model, the risk management is done by our local field partners. And we work with over 300 field partners around the planet, typically microfinance organizations. And then in our new venture, kivazip.org, we rely on trust networks. So I'll illustrate with the story. Right here in San Francisco, there was a gentleman named Victor. He immigrated from Mexico about 12 years ago. A very kind of low-income background, doesn't have a great credit score. He went to a technical assistance provider in the Mission District right here called the Mission Economic Development Agency. They work with Latino entrepreneurs to help them start businesses. He graduated from 60 hours of business training and went to apply for a bank loan and also a loan from a local CDFI. Was unable to qualify for it. He wanted to start a coffee shop. He then basically, because his instructor kind of saw kind of the entrepreneurial kind of gleam in Victor's eyes versus the other cohort of students that instructor was teaching, that instructor was allowed to, on this Kiva Zip website, to vouch for Victor's character. So it's kind of how banking was done 100 years ago. Your banker would go and talk to your pastor, ask your pastor about you, so on and so forth. Today, with the automated systems, it's fantastic, but there's a huge information gap that's left, especially for startup businesses where there's no operating track record like Victor. This guy who taught Victor vouches for Victor. Victor qualifies for a $5,000 crowd-funded loan from the internet community that gets funded. And then as he pays back that loan, he qualifies for a $10,000 loan. This is money that goes right to him via PayPal at 0% interest. It's a starter loan, a credit building product. But what gets interesting is as Victor repays his loan, it's like the eBay system, he builds his reputation, which not only helps accelerate him to the mainstream banks, get larger loans, but he can now vouch for other people. So he's vouched for 3 people, including Rocio, who's a house cleaner in San Francisco, who's bringing her vacuum cleaner on the city bus, and between dropping her kids off at school and picking them up after work, she was missing client appointments as a house cleaner. She needed $3,000 to buy a car. Her credit score didn't allow her to do that. Victor, knows Rocio really well. It was willing to vouch for her. And basically, she got a loan from the internet community. She's paid back. She's on to her second loan. And now Rocio has vouched for Eva, who sells at Bay Area flea markets. And so this trust graph of people vouching for people, it's really an old idea. Muhammad Yunus, back in the mid-'70s, got groups of women in a village to vouch for each other, essentially. We're trying to bring that now online and keep track of that in a very public way for those people who are underserved here in the US as well as around the planet, and see if we can actually reduce the cost of the interest rates that these folks have to pay to 10% or less. That's our aspiration, And today in the U.S. or here in San Francisco, 120 businesses are part of this pilot on Kiva Zip, have received loans from about 7,000 people. And there's a 95.5% repayment rate using this trust graph concept with people like Victor and Rocio and Eva.
Thank you.
For Upstart, credit scoring really is the centerpiece of we think of our innovation, and we are focused on, what the credit markets call the thin file borrower. And basically, we've built a model that does a bunch of things that go beyond what a traditional lender would do. We start with the obvious things others do, which is, current income, current debt levels, all the information you'd learn from a TransUnion report, like inquiries and bankruptcies or anything like that. But of course, in thin file borrowers, there's not much there, or there's often not much there. So we go beyond that, and we don't just look at employment, we look at employability. Young people typically change jobs a lot. Young people don't have years and years of credit history, but we think we can underwrite them by understanding their employability and their propensity to repay. And we do that principally with education-related variables, where they went to school. So after looking at their current financials, their debt loads, the way other lenders would do, their credit score, we understand where they went to college, which actually is predictive. We understand what they studied, which is even more predictive. And there's obvious things. Everybody knows, for example, a computer science major from a great school is not likely to be unemployed for a long period of time. But it's also true that nurses don't tend to be unemployed very often. So it's not a simple model at all. It's actually fairly sophisticated. And then also how they performed in school. Literally a GPA and a test score like an SAT are predictive. And that may seem, in one sense, obvious, and in one sense, not obvious. But if you think about it for a second, someone who's likely to care about a test score or care deeply about a GPA and work 4 years or more and watch the number, they're the same person that's going to later on care about a FICO score. And it's a sort of signal of behavior. And that's the essence of our model, is using millions of data points of borrowers historically and understanding how these different variables predict default rates.
Thank you. And when we were preparing for this panel, once again, I stood corrected with Dave. I was thinking of Mick Jagger attending LSE in London and dropping out and then being a superstar and being like, well, how do you factor that in? The outlier who doesn't finish college and his success. He assured me that is very much an outlier, which I very much believe. But I was impressed by the level of analysis that
I would love to loan money to Mick Jagger for sure, but sometimes you need a more data-driven model, unfortunately.
No, of course. So in terms of scale and massive scale, I just had a question for all of you around, and this, of course, is going to be an easier question for Kiva, which is already global. How do you reach massive scale? I mean, and do you have ambitions, I assume, to go international? There are lots of risks that come with that, including fraud, et cetera. I'm just curious to see what your ambitions are in terms of going to scale and what you think for your platform is the real market opportunity.
Well, I think we've seen massive scale already, not massive in terms of Lending Club Prosperous size, but we have seen huge demand from individuals looking for this type of funding. Mm-hmm. The issue with us for scaling at the moment is that this is a completely novel product, and to really have mainstream institutional investors start investing in income-linked payment agreements, as we call them, you need clarity around regulations, legal enforceability, tax treatment. Mm-hmm. The other route to scale for us would be more of a kind of retail-driven Kickstarter type of model. Mm-hmm. But both of those are really dependent on things that are outside of the company's control, so more kind of regulatory, legislative type of, developments. Mm-hmm. So I think that's a barrier for us. And the way we're going to scale is actually, similar to actually how our friends at Upstart are doing, is introducing more of a feeder product into the PAVE ecosystem, more of a vanilla type of loan instrument. And whilst that's obviously structurally different, it does serve a need out there. As Dave pointed out, a lot of people at the moment simply don't have access to funding. And that's really what PAVE's about, giving people access to funding and resources, both financial and non-financial, that will let their careers develop. So I think that's a stepping stone for us, and eventually we hope that we'll work with regulators to really show that income-based funding models are really the way forward and a viable financial investment compared to the traditional lending products out there.
And there are, part of the Tonic network also are education funds that are based on new models that have to do with percentage of income basically promised over time. So that's happening in Latin America, et cetera. So I was just curious if there's like a geographic sequencing here that you have.
Well, yeah, we've seen companies like Lumni operate kind of, in the more developing countries. There is legislation proposed now to actually, I guess, clarify and codify a lot of the income-linked payment agreements types of products that are out there. But I guess the more philanthropic end of the investment spectrum is also looking to get involved, which could also help push this kind of business further. So we're talking to a lot of foundations at the moment that are looking to actually use this type of product to invest in underprivileged kind of cohorts and minorities, fund education, and then of course there's all the I guess the 19 states that have adopted the pay-as-you-earn type of approach, which is similar to what we're espousing.
Great, thank you.
Oren brought up a good point around regulation, and obviously as we look to scale, just the nice thing about nonprofits is it's all public knowledge. We know that there's over $500 billion in secured credits in the U.S. alone. We know how much these organizations are paying in interest costs. It's all public data that can be accessed. So our focus is reaching domestically and growing that way, knowing that there's plenty of demand even domestically for that. And regulatorily, even the way we structure things, there's in the U.S. there's specific regulation and exemptions around nonprofit issued investments. So when you go beyond the borders, just understanding what are the dynamics regulatorily to be able to do that.
But Chris, tell us, what is the market opportunity to lending to nonprofits? Because I remember this in one of our conversations. It's in the order of billions, or?
Well, it's $500 billion is the actual amount of, that's nonprofit loans that have real estate as security. So those are secured loans, let alone, we're doing some unsecured credits as well for organizations. So the demand and the need in our marketplace is significant. And when you think of regulatorily over the last, since 2008, as the feds have come in, changed the banking environment, nonprofits have been squeezed as a result because the changes that regulators have placed on banks have made credits that don't have guarantors on them more difficult. And no nonprofit loan should be guaranteed by a board member. I mean, these are volunteer people stepping up. So to be able to lend to nonprofits is more difficult than it's ever been. So there's definitely a growing demand for solving this issue. And as loans, they're commercial in nature, as they come up for resets, we get calls all the time from nonprofits that just are in technical default, never missed a payment, but literally their credit has come due. The bank that currently holds it really is asking to be removed from the credit side of it, and no one else is stepping in. And so to be able to bring that community around, these are organizations that they have a seminal impact in that community. It's providing a vehicle for those organizations to move forward. And to date, every organization we've come alongside, they're financially healthier than they've ever been as a result of it, because you cultivate new donors. Those that invest, they're more vested in the success of the nonprofit. So it all proves to be a great solution for nonprofits.
Thank you. Pramil, in terms of scale, actually tell us what is the current scale of Kiva and Kiva Zip, and just give us a sense of size.
So Kiva, 1.1 million people have made a loan, have actually put money into the system, totaling $550 million, I think, now. And 3/4 of the loans go to women-run businesses. It's in 75 countries in terms of where the money's being deployed. And that's 1.2 million small businesses, farmers, and we recently started student lending as well. And the repayment rate right now is 98% on the main kiva.org website. On Kiva Zip, this new pilot site, still in alpha without an intermediary microfinance organization, the scale is 550 US small businesses, but growing pretty quickly now, and 2,300 small businesses in Kenya that are getting 0% interest loans right to their phone that can't get access from microfinance institutions that are charging about 35% interest. In terms of scale, one thing, my mental model is there's 2.5 billion people on the planet that are outside the access of formal financial services today. Kiva as a nonprofit, I don't believe we're going to be able to serve that, but what we want to do is give, basically, if there's the banks here, and then microfinance institutions are supposed to be on the edges of the banks, pushing out the banks' frontiers, kind of de-risking it over time. When Muhammad Yunus started 40 years ago, banks thought it was quite risky to lend to very poor women. Now he and the rest of the microfinance movement have demonstrated to banks, hey, you can actually lend profitably to very poor women all around the planet, and that's how we're going to get that scale. And then where Kiva sits as an internet public good is on the edge of microfinance itself, trying to basically de-risk things for the microfinance industry and ultimately the banking sector. So what I get excited about are super long-tenured loans when it comes to students. We're trying to jumpstart a student loan market abroad. When it comes to small businesses right here in the US, 7 out of 10 who apply for a bank loan get rejected, particularly minority-owned and low-income businesses. And so we're hoping that we can help establish these track records through the platform activity and then ideally crowd in other commercial players. That's our path to scale.
Great. Thank you.
Sure. Well, we're a new platform, so our focus is just getting critical mass in the U.S. Consumer and education market. And I mean, it's inspiring to see, obviously, what Lending Club's done over the years. What Prosper's really done in the last year is extraordinary. And we're just working on a unique value proposition for a very unique borrower with a product that fits what they need. And so near term, certainly for the next number of years, we're focused on the U.S. market. When I was at Google and we shipped a product, we had a mandate from Eric Schmidt that we had to have it in, I think it was 30 to 40 languages within 90 days of shipping it, and we just had to be focused on being global instantly. This industry obviously is radically different because of the regulatory environment and the very different nature of different countries, and you have to look no further than Lending Club themselves, who are probably on the verge of going public, even if Renault won't say so, and are still in one country. That's pretty telling how challenging it is to think about dealing with the regulatory regime in different parts of the world.
Yeah. Thank you. So my final question to you guys is about predictions. It's really just about the future of this market, especially I was going to say in the United States, but maybe in Europe, or in the UK, or for Premal to talk more about Kenya and where M-Pesa is well anchored. But so what are your predictions for, let's say, the 10 to 20 coming years in the P2P lending, especially in this case post-ed, thin credit score sector?
Well, I think one of our hopes at PAVE is really that we provide a lot more people access to funding from other real individuals who will have be able to provide them with financial and non-financial resources. I think one of the big trends we're seeing is customization. Even on Lending Club and Prosper, you're seeing obviously institutional investors be able to customize the type of exposure they want. And our vision is really to bring that level of customization to an affinity type of level. So if you want to invest in your alma mater, such as you went to Columbia, you want to invest in Columbia graduates, or you want to invest in coders taking General Assembly courses, or female entrepreneurs like we have live on PAVE now, you can target that specific demographic and provide those people that you care about with funding and access to advice, guidance, connections. And I think in a way we're kind of seeing a reinvention of where banking kind of started, where that kind of merchant banking type of model in that sense, and I think it's going to keep developing. And that's actually been the biggest pull for customers to PAVE, so from effective borrowers to PAVE, is people actually really value the human connections that are being created. And so our hope and what we're trying to put out there is a re-establishment of those connections across society, and this whole kind of, I guess, disintermediating, but coupled with a new product, a new, if not old, way of thinking.
Thank you.
Well, yeah, I think what's neat about each of us And you think at a macro level is, I think the whole socially conscious and intentional investing is becoming a much more important just decision process for at least the individual investor out there. I mean, as they look at how they're deploying their resources, I think that's one of the fastest growing on the investment sides sectors is this socially conscious investing. And each one of us, you can argue there's value, and there's people could rally behind that and see the impact that their dollars are having. And so I look at it, if you're talking about where this is going, I just think everyone, as they're managing resources, they're just asking the question, all things being equal, can I accomplish financial goals while also having social impact? And can I make a difference with the dollars I'm having? And it's almost that conversation of establishing legacy with the dollars people are given. And community and relationships, those are important to people now more than ever. And so I think this is just really the tip of the iceberg on how and where it can go from here. I think it goes beyond borrowing. It goes into, people have been up here talking about equity ways to invest. So I just think it's much bigger than where we are today, but I think this is a start.
Including for products that have, like Semble or Kiva 0 to 2% interest rates? Are you bullish on that market as well? I mean, that's a pretty quasi-philanthropic sector. Well,
I look at even what we do. It's not. It's proportional risk as I look at it. I mean, these are what the credits we structure, or they're with commercial borrowers that have strong collateral. Obviously, inherently in that, there's not huge return expectations. So it's low risk, low reward type opportunities. But by connecting source to the need, you can bring value to both sides.
Thank you.
I think it's an interesting question around rate of return and scalability. And one thing that we ask ourselves consistently at Kiva is, could we make more impact if we retained a nonprofit status, if we allowed the market interest rate to float so that people, Kiva lenders, could earn a rate of return? Could we actually help more people, crowd in more commercial investors eventually to take solutions to scale that help really poor people? And let's imagine that there's a wand that we could wave, and from a regulatory perspective, it were easy to do. And in all the, our lenders come from not only just the U.S., so it's not just the SEC, but they're from 180 countries worldwide. So there's a lot of different kind of jurisdictions that we'd have to. Let's say we can wave a magic wand to do this as an internet public good. Would it make the most sense? And I think the vision that I wonder about 2 decades from now, to your question, Stephanie, is if this room, I just came back from Kenya, if this room were the country of Kenya, everyone from here to here would be rural subsistence farmers. And the cost of reaching you with financial services is so expensive. That's why there's still 2.5 billion people outside of the access today. But with mobile phones and then new alternative credit scoring things that you all are developing, this whole conference is really going to emerge. I imagine that we're going to develop better heuristics that would allow that woman right from her hut to basically, she'll have a track record even if she doesn't have a formal credit score, quote unquote. But there'll be a number of different kind of ways of getting at her credit worthiness, and she'll be able to post herself up onto a crowdfunding platform, have people around the planet as well as institutions bid down her interest rates, and then basically she would be able to have more options than she does today. And I would love to see that vision emerge. Right now, what we're seeing at Kiva with the kind of 1 million or so folks who've self-selected into the system who've made a loan, there's a little bit of discomfort when you have a sense of connection with someone. It's somehow, when we ask our users, over half feel that it's distasteful to earn a rate of return off of someone who's poor. So there's still, I think, a bit of an evolution that might need to happen in the consumer or retail investor mindset around blending, how profit can serve impact. Yeah. And that's something that we've run into when just talking to our existing Kiva lenders. So something to think through, but I'm sure there'll be models that make that attempt, and I'm excited about it.
Thank you.
So when I think of 10 to 15 years, my model is, I tend to think of what Mark Andreessen said, which is software is eating the world. And the internet has disrupted industry after industry in its last 20 years. Financial services and maybe healthcare are two of the last that have not been served up for dinner, so to speak, because they're so heavily regulated, and it took a long time. But software is beginning to eat the world of financial services, and when you think about lending in particular, you begin to be able to do things economically you could never do before. When you think about the cost of acquiring borrowers and where they come from and how they find you and what that costs, when you think of just verifying information about borrowers and the trust that you need in order to lend to somebody, that is falling, and guys like Lending Club have been doing this in an amazing way for years, but there's still more to do. The underwriting model itself, where we have a lot of focus, there's a lot more data out there that's not being used to properly underwrite and price loans and make them more affordable to more people in more places, and the servicing side as well. So I think this industry is just at the very beginning stages. It's maybe where like bookstores and retail and things like that were 15 years ago when the internet began to disrupt them. So I think the future is very bright, that the more you get rid of these transactional costs, the more you can provide value to the borrower, the more that you can serve underbanked, you can serve people in parts of the world that wouldn't economically be able to be reached before. I definitely come from the model of, nonprofits are amazing for doing things that can't be solved commercially. We are on the commercial side and do believe like building a model that has better underwriting, serves a community that's underserved, and do it in a way that's profitable and self-generating and self-sustaining is a really good thing. But I think all these things come together to me into a very optimistic view of the future, which is we're going to be able to serve more people. The thing that's funny that Premal just said about the idea of somebody earning a return, I have to thank my good friend Tonio for pointing me toward the book of 5,000 years of debt, and learning how there's really 5,000 years of sort of at best dislike for lenders. People that provide money and sit back while someone through hard labor pays them back. And there's certainly a sense about that, right? That I think is undeniable. But at the same time, credit is a cornerstone and fundamental to our economy at ways you can't even imagine. We all know what happens when credit dries up. So I think the idea of lower cost providers that are much more flexible, using data in better ways, reaching people that can't be reached, makes me very optimistic about 10 years from now.
Thank you so much. So now we're going to turn to the audience. We've got about 10 minutes for Q&A. Does anyone have questions for our panel? Sir, I think we need a mic here. Please just state your name and your company.
Hi, this is Soumya from Cognizant. I have a question for the panel. Do you see, talking about innovation, do you see virtual currencies like Bitcoin helping or aiding or accelerating that process of disruption in what you are trying to do in your companies?
Who wants to take that?
I mean, I can say in the international context, the more frictionless you can make payments, the better it's going to be. And so to the extent that there's a minimal cost, no cost alternative to the system today that allows me to reach that person in Rwanda or in India or in Oakland, California, and with minimal leakage from the system, that's going to serve. It's going to bring down the cost and drive innovation. The challenge with cryptocurrencies like Bitcoin is in the context where we work today. People, I mean, it's so far off to imagine because many of the people we work with are just getting online, just getting banked, so on and so forth. So I looked, if you take a multi-decade view, I think it could help, certainly.
Thank you. Any other questions from the audience? Sir, one.
My name is Paul Jeffrey. I wonder if you could share with us your thoughts with regard to the notion of reputational capital. When you look at the notion of next generation insights into credit scoring, one of the implied assumptions appears to be that there's an interrelationship between a person's character and their creditworthiness that is not currently being captured in conventional data. So my question is, A, do you think that's true? B, who, in your opinion, is doing the best work that you're aware of in respect of generating reputational capital dashboards?
Warren, do you want to start?
Yeah, I think from our perspective, we do believe that there is there's an element that supports that argument. Reputation is important. We have on our platform, it's a market-based kind of funding platform. So to the extent that people are able to go out and self-market and have a good reputation and I guess a strong resume that they can find capital for, then they have an easier chance of raising funding than others. And we do believe that I think those people are going to perform better than actually if they raise funding from traditional kind of faceless institution type of capital. So we haven't got really enough data yet to prove that out. But just anecdotally, we've heard strong evidence that actually when people receive funding on PAVE, they really feel like they want to perform well for the people who've invested in them, taking a risk investing in them. And I think for our structure, the way we're funding it, since it's an investment in someone's future earnings, there's even more of a sense of actually wanting to do well versus just having borrowed money, because it is a risk-on investment. In terms of people out there who are doing innovative things in the space, I know kind of Lendo's in the space. There's a host of other companies looking at these areas. It's something that we do and will keep developing. But as it's, we've probably got enough on our plate just with the core product at the moment.
Speaking to that, one of the unique dynamics of what our platform does is, some of the other peer-to-peer lending platforms, you don't actually know who the borrower is. Ours, it's very clear. I mean, in many ways, it's that relational context that even drives the person's decision to invest, because these are, you're reaching a community that already sport, let's say it's a boys and girls club, and they have a facility and we're refinancing $3 million of debt on that facility. Well, they're the ones that probably know that organization better than anyone. It really starts with the relationship. It starts with the social context that even has them at the table to make that investment. Then they're evaluating the investment aspect of it. But I think that definitely proves that people are more comfortable at times having that that level of comfort on who the borrower is and knowing who they are qualitatively versus quantitatively. And so I definitely see that as a growing trend, and it has been with everyone else doing in this industry.
Thank you. Dave?
I think lending is essentially trying to predict the future and what's going to happen in a certain scenario over the next few years. And reputation is part of it, but there are other ways to capture signals. I've heard a lot about lenders looking at Facebook and your followers and inherited trustworthiness and creditworthiness and all that. Some of that I feel like, frankly, is pretty hokey. But it is important to consider broadly, other sources of data that can, at scale, provide an indication, of someone who's a good borrower. And I think there's a lot of more interesting things around the sort of trust graph notion and the notion that people that have relationships to each other can provide support and ability to create, in effect, quality borrowers. And so I think it's a lot of interesting area and a lot of science to be worked on for years to come.
I'll give you a specific thing we just heard from a borrower here in San Francisco on Kiva Zip. She said, "This is the first loan I've ever received that I felt like I needed to repay." And we asked her why.
Is that good or bad, Premal?
Well, it's interesting. She was like, because there are real people on the other side of it. So not only was it crowdfunded by 40 or so folks on the internet, you can see their photos, but also someone stuck their neck out for her to vouch for them. A technical assistance provider, a church pastor, someone in her community. So it is interesting, if you can humanize the creditor or the group of creditors, does that somehow change borrower psychology? A lot more data needs to be, the N needs to get a lot larger on this, but I think it's an exciting time to understand that.
Thank you. So one last question and we'll wrap. Here, sir.
Hi there, this is Rajesh from LendIt. I have a question regarding institutional investors and impact investments. Can you give? guys saw how the trends are looking.
Can you be a little bit more specific? Because
so you guys talked about, retail investors specifically into impact investments, but how is the trends looking in terms of institutional investors participating into your platforms?
Okay, so just so that you know, the word impact investment is used very broadly. So these entrepreneurs may or may not want to be qualified as such. So I just wanted to put that as a caveat. But maybe we should start with you, Dave, because you've had an incredible run recently in terms
Sure.
of raising funds.
You know, I think institutions generally fall into a camp of having a mission they're driven, and they're either sort of not for profit in the pursuit of that mission, or they're, very happy to accept very low returns. Or on the other side, they're just pure market driven. I haven't seen many that sit in between that, or any perhaps, and I actually think that's fine. If you're in the mission-driven thing, you really, if you expect them to invest in your product, you need to be incredibly aligned with the outcome they're looking to achieve. I do think it's a little dangerous for companies to sit in the middle of it too much and be sort of mission-driven, sort of capitalistic, if you will, because I think in a lot of people's minds, they occupy different spheres in their brain.
Mm-hmm.
The part that wants to maximize return and the part that wants to have some impact and have some good in the world. I wish it weren't that way, but I think that, frankly, is how most people's brains are wired.
Mm-hmm. Yeah. So, Premal.
Reid Hoffman, who's the founder of LinkedIn, sits on our board, and he was looking at our numbers, and compared to Amazon, LinkedIn, eBay, kind of these platforms that have really scaled, Kiva, interesting, but good for a nonprofit, but wondered, is there anything to kind of really juice the growth? And so this is an interesting kind of way to deploy a large amount of money. He put $1 million onto the platform. And what he decided to do is, instead of lending it out $25 at a time, 40,000 times, like he's cash rich and time poor, he allowed 40,000 people on Twitter to lend out his money. And the catch is as that person in Des Moines, Iowa lends out Reid Hoffman's money to someone in Cambodia, as that woman in Cambodia repays, the money goes back to Reid Hoffman. So we did this trial in March of 2012. 40,000 people claimed it within a month. You could help someone for free, lend a billionaire's money. Over the next 14 months, Reid Hoffman got paid back $994,000 to his account, and he could pull that money out. So his loss was $6,000. And then those 40,000 people put in an incremental $1.2 million of their own money into the Kiva system, which will then recycle. So it's kind of a 1 to 200 philanthropic leverage.
Yeah.
Which I totally agree. I think Kiva's definitely a charitable lending platform, and what we're experimenting with is, can you take kind of large pools of money, balance sheets, and allow your customers, your employee bases, so on and so forth, the Twitter sphere, to lend it out, and then the money comes back to you. In the process, you help a lot of people get started with a free account, and then they start putting in their own money. Since then, Google has done this for all 35,000 employees. So you get free lunch at Google, and now it's all 35,000 get $75 free to lend on Kiva. Hewlett-Packard just did this with a bunch. So that's how we plan to attack
wrap here, unfortunately. But I wanted to thank this incredible panel, both in terms of their work, which is both innovative and high impact. So Oren Bass from PAVE, Dave Gerard from Upstart, Premal Shah from Kiva, and Chris Walcott from Semble. Thank you so much. Thank you.